This is a timeline graph tracking global asset classes starting February 28, 2026. The immediate impact of the US-Iran conflict and the de facto closure of the Strait of Hormuz is highly visible, a 69% surge in WTI crude oil. That constraint on global supply instantly bled into other energy markets, with European natural gas prices spiking 61% along a nearly identical trajectory. But observe Western equities in the exact same window. The Nasdaq drops sharply into correction territory, showing a stark inverse correlation between Middle Eastern energy input costs and Western tech valuations. A temporary truce brokered by Pakistan and negotiated by diplomats like Iranian Foreign Minister Abbas Araghchi sparked a sharp relief rally across those markets. A brief pause in hostilities, however, does not instantly reopen physical shipping lanes or repair damaged energy infrastructure. The relief rally is trading on sentiment, masking the underlying structural damage to the economy. What began as a regional conflict has mutated into a synchronized supply-side stagflationary shock. To map out exactly where the global economy is heading, we have to trace this shock outward from the physical blockades at sea, through the sudden stalling of the global AI boom, and finally to the resulting policy paralysis at the world's central banks. Treating this event as a localized energy issue leads to a systemic mispricing of risk across every major asset class. The physical reality of the Strait of Hormuz blockade is a daily transit loss of 15 million barrels of oil. Supply chains on this scale carry immense momentum, and halting them creates a backlog that will take months to clear. Before the conflict, Fitch Ratings modeled an oversupplied market, placing the baseline average for Brent crude at $70 a barrel for the year. This chart builds out Fitch's current price scenarios based on the conflict. If the strait remains effectively closed for just 3 months, that baseline jumps to an average of $100 a barrel. But averages obscure the acute daily pain. Within that 3-month window, markets have to absorb extreme price volatility, with expected spikes pushing the price to $130 a barrel. If the closure extends to 6 months, the entire floor elevates again, shifting the annual average to $120 a barrel. Under the 6-month model, the system hits its stress limits. Prices peak at $170, requiring a severe 5.5% destruction in global demand just to force the market back into balance. Beyond the transit blockades, there is hard infrastructure damage. Direct strikes on Qatar's Ras Laffan complex have knocked 17% of its total export capacity offline. Rebuilding specialized liquefied natural gas facilities takes 3 to 5 years. Long after a diplomatic ceasefire is signed, the energy deficit will remain structural. That structural energy deficit immediately crosses over into an unexpected sector: global agriculture. Approximately 1/3 of the entire global fertilizer trade relies on shipments transiting through the Strait of Hormuz. Because natural gas is the primary feedstock for nitrogen-based fertilizers, a spike in European and Middle Eastern gas prices translates directly into a spike in farming inputs. This bar chart isolates World Bank commodity data for the first quarter of 2026, capturing a steep 46% month-on-month surge in the price of urea. Agricultural cycles operate on a delay. The expensive fertilizer purchased for spring planting guarantees a severe wave of food inflation hitting grocery supply chains months down the line. The human toll of this delay is highly predictable. The World Food Program estimates this specific supply shock will push an additional 45 million people into acute hunger by mid-year. Net food importing economies in Latin America and East Africa are absorbing the blunt force of this impact. When a population can no longer afford basic calories, an industrial pricing problem escalates rapidly into a sovereign stability crisis. While emerging markets face an agricultural crisis, Western economies are watching their primary growth engines stall: the $1.5 trillion global tech and AI investment boom. In 2025, capital expenditures on IT and artificial intelligence accounted for up to 39% of total global economic growth. We tend to think of the digital economy as weightless, but training and deploying AI requires a vast volume of physical industrial commodities. This proportional block model maps the physical inputs required for AI infrastructure. First, we see a critical 33% global shortfall in helium, an element absolutely essential for semiconductor manufacturing. Second, the model isolates a 9% supply deficit in aluminum, a raw material necessary to physically construct the data centers. Finally, look at the baseload energy component. The cost to power these sprawling server farms is expanding significantly under the weight of the global oil and gas squeeze. When you combine expensive chips, expensive metal, and expensive electricity, the projected returns on investment for new AI projects collapse. With this capital expenditure sidelined, the OECD has already downgraded global growth projections for 2026 to a sluggish 2.9%. Western tech equity valuations cannot exist in a vacuum. They remain entirely tethered to the physical limitations of Middle Eastern commodity bottlenecks. Faced with these bottlenecks, the corporate sector is executing a coordinated structural shift in global procurement strategy. This flowchart contrasts the old model with the new reality. Pre-2026 supply chains ran on a linear, just-in-time model, perfectly optimized to strip out costs. Post-2026 procurement requires a complex network built entirely for redundancy and resilience. That resilience carries an enormous price tag. Operating margins are being actively eroded by rerouted freight pathways, elevated fuel costs, spiking insurance premiums, and currency volatility. Highly integrated sectors, reliant on precise international coordination, are the most exposed. Automotive manufacturing is seeing electronic component delays, while pharmaceutical companies are struggling to source active chemical ingredients. To prevent assembly lines from halting entirely, corporations are forced to finance and warehouse expansive inventory buffers, commonly referred to as safety stock. Holding excess inventory ties up working capital. By abandoning cost efficiency for basic operational survival, global manufacturing has placed a persistent inflationary floor under the price of nearly all physical goods. We are now looking at true stagflation. Supply-driven price spikes are actively colliding with a stalling economic growth engine. The responsibility to manage this crisis falls to international financial institutions like the IMF, the World Bank, and Western central banks. But this conceptual matrix maps a strict policy mismatch. Central banks are equipped with demand-side tools, like adjusting interest rates, which are virtually useless against a physical supply-side blockade. Governments cannot simply spend their way out of this shock either. Average public debt has reached 123% of GDP, meaning the fiscal policy space required to subsidize consumer costs is largely exhausted. Furthermore, governments are locked into structural deficits averaging 5.7%. This creates total fiscal paralysis. This leaves central bank chairs completely boxed in. They cannot safely cut interest rates to re-stimulate the stalling AI boom, because doing so would pour gasoline on an already untamed commodity inflation fire. Watching the broader market celebrate a temporary diplomatic truce is a dangerous distraction from these binding mathematical constraints. The 2026 supply shock is a structural re-rating of global capital allocation that will persist long after the current diplomatic headlines fade. By degrading the global supply chain, inflating the baseline cost of energy, and paralyzing monetary policy, it has forced a long-term shift in the global economy.